If your business is scaling and needs immediate breathing room to cover raw materials, payroll, or large purchase orders, the SBA's new 7A Working Capital Pilot Program offers a massive lifeline. We are talking about highly flexible lines of credit reaching up to $5 million. But there is a massive catch. A mandatory 12-month operating history disqualifies new startups immediately. The Working Capital Pilot operates as the SBA's premier, modernized, monitored line of credit. You draw exactly what you need, repay it when invoices clear, and draw again. It keeps your daily operations moving, freeing up capital that would otherwise be trapped in warehouse inventory or unpaid client invoices. The ultimate test of whether you'll get approved comes down to your back office. You have to prove you have the rigorous accounting controls in place to actually manage and track these funds. For loans up to $150,000, the government guarantees 85%. Over $150,000, it drops to 75%. These facilities cap at a 60-month maturity limit, stretching up to 10 years. Interest is pegged to prime, tightly capped from base plus 6.5% down to 3.0%. To secure those rates, your paperwork has to be flawless. You must provide complete tax returns, up-to-date balance sheets, profit and loss statements, and a highly detailed business plan. Keep in mind, the government does not write you a check directly. You have to secure this line through a participating commercial bank or credit union, which you can locate using the SBA's Lender Match tool. The timeline to get your money depends heavily on the bank you choose. Lenders with delegated authority can process and approve your application entirely in-house, significantly speeding up the timeline compared to lenders who must send it away for federal review. So while the SBA sets those rate caps and guarantees the risk, the commercial bank is the actual gatekeeper. They dictate exactly how fast your application moves and whether you secure the funding at all. Once approved, you can structure the credit line to solve two very different cash flow problems.
This video contains affiliate links. I have a relationship with the brands in this video and earn a referral fee when you shop through the links in the description below. Before we dive into securing major business grants and funding, let's talk about your foundation. You absolutely cannot win grants or build serious business credit without a properly structured legal entity. Most people try to apply for funding as a sole proprietor, or they cut corners on their setup. And that is exactly why their applications get instantly rejected. Funding institutions and grant committees require your business to be a legitimate, separate legal entity. That's where BZ comes in. BZ is the absolute best formation service out there, handling your entire LLC or corporation setup for $0 plus state fees. They take care of your articles of organization, registered agent service. You need to establish that legal separation and look credible to lenders. Once your legal foundation is set, you need a strategic partner to actually track down and win that capital. That's where HelloSkip comes in. HelloSkip is an incredible AI-powered platform built specifically to help you discover, apply for, and secure funding. They give you access to a massive database of active grants, and even award their own capital, including weekly $1,000 instant grants and recurring $10,000 merit-based grants. Plus, their platform provides tailored, specific guidance to optimize your applications and drastically increase your chances of winning. Having a clean legal structure and an automated funding tool is non-negotiable if you want to scale. I've linked my full, in-depth reviews of both BZ and HelloSkip in the description below. Make sure to use my links in the description to register your company with BZ and sign up for HelloSkip today to unlock exclusive discounts, tools, and perks.
The first path is transaction-based lending for project financing. If you land a massive purchase order but lack the cash to buy the materials to fulfill it, this structure lets you access working capital early in your sales cycle. You use the funds strictly to execute that specific contract. The rules here are rigid. You cannot use this money to buy long-term real estate, purchase heavy equipment, or pay down unrelated business debt. It is strictly locked to that project. The second path is asset-based lending. This is built for businesses struggling with a different bottleneck: slow-paying clients. Instead of waiting 60 or 90 days for invoices to clear, you can borrow directly against your current accounts receivable and the physical inventory sitting in your warehouse. The trade-off is intense operational scrutiny. You have to submit to continuous monitoring that mirrors the strict reporting standards of private, institutional, asset-based facilities. The working capital pilot adapts to how your company makes money, provided every dollar is deployed to generate immediate operational momentum, rather than to cover long-term structural debt. Domestic manufacturers dealing with volatile raw material prices and steep labor costs get a distinct advantage under this pilot. The SBA rolled out the MARC initiative, the manufacturer's access to revolving credit, specifically to help small manufacturing firms access these funds with minimal red tape. The program also offers a major carve-out for companies engaged in international trade, including firms looking to export for the very first time. Traditionally, you'd need a separate line of credit just to handle the unique risks of foreign sales. Now you can finance both your domestic projects and your international orders under a single unified loan facility. Merging everything into one facility cleans up your balance sheet and simplifies your debt structure. The trade-off is that you are now tying all of your company's operational risk to a single primary lender. Before you apply, we have to look objectively at what this money costs. The biggest upside is the program's new annual short-term guarantee fee structure. Unlike a standard term loan, where you pay for the entire life of the debt up front, you can customize the duration of this credit line. You only pay a proportional fee for the exact years you actually require the facility. Furthermore, interest is exclusively charged on the capital you actively draw down, making it a highly efficient way to manage your cash flow without overpaying. But you pay for that financial efficiency in strict compliance. The first absolute hurdle is the inflexible 12-month operational history requirement. This rule has no loopholes. Even if you are buying an existing business, the target company must have a full 12 months of operations on the books. Brand new startups are disqualified. The second major hurdle is the intense administrative burden required to maintain the credit line. Your lender is required to perform a full credit analysis on your business every single year to renew the facility. That means you are legally obligated to produce timely, flawless reporting. You must consistently generate accurate accounts receivable agings, accounts payable agings, and up-to-date inventory reports. The math is simple. You get access to highly affordable, government-backed capital, but you pay for it with the high labor cost of non-stop, institutional-grade financial reporting. Plotting accounting rigor against capital need, the ideal candidate sits in the top right. The clear winners are established, asset-rich but cash-poor businesses with heavy inventory and immaculate bookkeeping. In the bottom left are immediate rejections, startups under a year old, and companies with disorganized accounting. Lenders treat the WCP as a rigorous financial instrument, strictly avoiding businesses in need of a bailout. It functions as a highly efficient, low-waste tool engineered specifically for growing, modern businesses. If your documentation is lacking, your first priority must be fixing your financial reporting systems to actually handle an asset-based facility in the future. Ultimately, the SBA rewards businesses that already have their operational house in order, handing them the flexible capital they need to permanently scale.